Hello everyone, welcome to another video for CFA Level. In today's video, we will be doing the last portion of Portfolio Risk and Return Part 2, and the topic name is Portfolio Evaluation. Okay, so far in the 10-11 video series that we have done for Part 1 and Part 2, what we have seen is that we have deep dived into risk aspects of a portfolio, we have deep dived into the return aspects of a portfolio, right? We have also seen how risk and return interact with each other in terms of the kind of risk that you take and the kind of return that you can expect. Okay, so far so good. Okay, but now the question is, what about evaluating how a portfolio manager has performed? So the first step that we did was creating an expectation. Okay, correct. So far in the 10 video series that we have seen, we were doing nothing but we were creating expectations based on the risk that someone is taking, what kind of return he or she should get. Okay, we have created the expectation. Second, what will be the second step? Second step is actually executing, which means creating a portfolio. Correct. Do we need to do anything in it? Creating a portfolio? Ideally, no. Third step, collecting the results. Collecting results. Now again, in this method, in this process of collecting results, there are various steps that we need to take care of, which we will be studying later in the course, right? But once you have collected the result, the fourth is evaluation. Correct. What does evaluation mean? Evaluation means that now I have the actual result at hand, I had the expectation, I also have the expectation which I had developed basis the risk that I'm taking. Now what I have to do, I have to simply compare the actual. I have to compare the actual versus the expectation to see, correct? To see whether I am meeting my expectation, whether I am surpassing it, or whether I'm not able to meet my expectation. Guys, are we clear? Guys, are we clear with this? Are we clear with the entire thought process behind performance evaluation? Now, how do we compare it? Okay. Now, how do we say that yes, we have met the expectation, or how do we say that we have exceeded the expectation? For this, there are certain measures, there are certain calculations, there are certain formulas, and each of the formula gives you a different level, different degree of evaluation. Some will help you evaluate your portfolio against the systematic risk. Some will help you evaluate the portfolio against total risk. Some will help you evaluate your portfolio against similar market portfolio. Correct? So there are degrees, there are different parameters through which these expectations are evaluated. Okay. So we will learn them one by one over here. So the topic name is performance evaluation. See, the first thing that we are said is performance has two components, risk and return. Yes, and this is very important for us to understand. See, whenever we are talking about performance, we always remember return, but we often forget risk. Okay, but if you look at the entire concept in a very holistic manner, without taking appropriate risk, you won't be able to achieve appropriate return, guys. Yes or no? Yes. So when you are considering performance, don't you think risk and return are both important measures? Guys, don't you think risk and return are both important? So it is important to look at the entire concept of performance holistically, and thus we have to see both risk and return. Okay. Further, along with the return maximization is a laudable objective. Comparing just the return of a portfolio with the market is not sufficient. Very correct. See, what it is saying that comparing the returns alone is not sufficient. Correct. Why? Because we all know returns depend upon the level of risk that I'm taking. Okay. So when you are just comparing the returns in an isolated manner, it might not give you the true picture. Why? Because somebody with a higher return might have taken a higher risk. Correct. So yes, this statement is very valid. Second, since returns, since investors are risk averse, where did we learn investors are risk averse? Investors are risk averse was discussed in capital market theory. Capital market theory. Correct. In the capital market theory, we had seen investors are risk averse. Return per unit of risk. This is a very important metric. Return per unit of risk. Very important metric will be an appropriate measure. And this return per unit of risk is something which is denoted by different measures. Different measures. Are we clear? So you see, so you will see there are overall 4 to 5 measures, okay, which primarily indicate, return per unit of risk, and we will see one by one. The first is Sharpe ratio. Guys, let me be very clear. Sharpe ratio is the most important measure and widely asked or used in questions. Okay, so very important and widely used. Let us read what Sharpe ratio is saying. It is a ratio of return excess of the risk-free return per unit of risk taken. So what it is saying, it is return that your portfolio has made over and above the risk-free return. So basically, even if you were not taking risk, you would have earned RF. We all know RF is a risk-free return, but your portfolio took a risk and earned something more, right? So I am only interested in the delta. I am only interested in the differential for the perspective of Sharpe ratio. It is also known as reward to volatility ratio. Yes, sometimes in the question you will be given reward to volatility ratio rather than Sharpe ratio. So again, important to know that reward to volatility ratio is also Sharpe ratio. Okay, Sharpe ratio of all portfolio along the CML are same. Guys, do you remember what is a capital market line? We have studied about the capital market line. Guys, do you remember? So what it is saying that any portfolio that you take on the CML line, any portfolio that you will take, you will have the same Sharpe ratio. What does it mean? It means that any portfolio on the CML will give you the same excess return per unit of risk. Let me repeat. It is saying that any portfolio on CML will give same return same excess return per unit of risk. Are we clear, guys? Okay. Higher the Sharpe ratio, it represents a better risk adjusted return. Yes. When my Sharpe ratio is higher, it means the excess return that I am generating using the risk is higher. So what is the formula of Sharpe ratio? Very important, guys. It is RP. What is RP? RP is nothing but a return of portfolio. Guys, RP is return of portfolio minus RF. What is RF? Guys, we know RF is nothing but risk-free return divided by sigma P. Guys, what is sigma P? We all know standard deviation of portfolio. What is standard deviation of portfolio? It is a measure of risk, guys. So basically what are we saying? In a nutshell, we are saying excess return divided by total risk. Guys, in a nutshell, this is only what we are saying. RP minus RF by sigma B. Guys, very clear, very simple, correct? The second ratio that we will do is Treynor ratio. Treynor ratio is similar to Sharpe ratio. The only difference is in the denominator rather than the total risk. So similar to Sharpe ratio, but in denominator we have beta. We have beta. Now guys, I'm sure beta of the portfolio. Now guys, I'm sure you can say and you can understand what does beta of the portfolio means. Beta of the portfolio means we are over here are saying excess return per unit of systematic risk rather than total risk. Rather than total risk, we have see rather than total risk, we are cancelling total risk and we have systematic risk. Guys, are we clear? So Treynor ratio is similar to Sharpe ratio, but in Sharpe ratio, we had the total risk in the denominator sigma p. In Treynor ratio, we have systematic risk in the denominator, that is beta p. Are we clear? Guys, are these things making sense? The next ratio that we will see is Jensen's alpha. The next ratio that we will see is Jensen's alpha. Again, Jensen's alpha is a measure of systematic risk. How it is a measure of systematic risk, we will see. It is the difference between the actual portfolio return and calculated risk adjusted return using the CAPM model. So what are we doing in the Jensen's alpha is, it is simple. We are saying what is my actual return minus what is my expected return. Nothing else. As simple as it can get. What we are doing in Jensen's alpha is we are doing actual return minus the expected return. Very simple. Okay. Actual return is denoted by RP. Expected return is calculated using the CAPM model. And if you remember, I had told you CAPM model has an application further as we go on studying. So this is the first application that we have. CAPM model. Guys, can you help me remember what was the CAPM model? It was RF plus beta into RM minus RF. Guys, this was the CAPM model. Now if you look at it, in the CAPM model, we are using beta instead of sigma. So what does it mean? It means that this expected return is computed basis systematic risk, correct? Since you are using beta instead of sigma, can we say this expected return is calculated basis the systematic risk that you are taking in your portfolio? Correct. That is why we are mentioning that it is a measure based on systematic risk. Guys, are we clear? See, another point which is mentioned over here is that alpha. What is alpha? Jensen's alpha of the market is 0. Definitely it will be 0. Why? Because if we consider Jensen's alpha of the market, the formula will be RM minus RF plus beta into RM minus RF. Correct? Correct? Can we say? Guys, can we say this? Now what will happen? See, if we are talking about the market portfolio, beta will be 1. Correct? If beta is 1, then the and we open the formula, it will be RM minus RF minus RM plus RF. So they will cancel out each other and the Jensen's alpha will be 0. So it means then when we are taking the market portfolio, my alpha will be 0. My Jensen's alpha will be 0, which means I am not earning anything more than what is expected out of my portfolio. I'm just earning what is expected out of my portfolio in case of Jensen's alpha for a market portfolio. Okay. The last measure that we will study is m squared. Okay. See, this is also very similar, okay, to what we have just read in, you know, what we have just read in Jensen's alpha. That is why we are doing it after alpha. If you look at the way we have studied, first we did Sharpe ratio, then we did Treynor ratio, then we did Jensen's alpha, and then we are doing m squared. Why? Because Treynor ratio was inspired from the Sharpe ratio, and m squared will be inspired by the Jensen's. N squared will be inspired by the Jensen's alpha. So are we clear, guys? Now we will see what m squared is. Now, if you look at m squared, what it is saying, it is an extension of Sharpe ratio. Why it is saying it is an extension of Sharpe ratio? Because it is based on total risk. Guys, since it is based on total risk, we are saying it is an extension of Sharpe ratio. But I am telling you, once we do it, you will see it is more related. It is more like the Jensen's alpha, but instead of beta, there is sigma. Okay, let us see. It is an extension of Sharpe ratio in the sense that it is based on total risk and not beta risk. Okay. The idea behind this measure is to create a portfolio that mimics the risk of the market portfolio. See, create a portfolio that mimics the risk of a market portfolio. Can we say we are trying to compute expectation over here? We are trying to create expectation over here. This is the risk that I am taking. It will give a ranking which will be at par with the Sharpe ratio. Definitely, since it is based on the measure of total risk, there are high chances that the kind of result that it will give me for my portfolio will be similar to that of the Sharpe ratio. A portfolio that matches the performance of the market will have an m squared of 0. See, again, portfolio having a performance of the market. Over here as well, if you see, the market portfolio Jensen's alpha was 0. Similarly, market portfolio's m squared is also 0. Market portfolio's m squared is also 0, just like Jensen's alpha, correct? And the portfolio that outperforms the market will be positive, correct? Over here also, if you see, if my RP, that is my actual return, is higher than the expected return, then my alpha will be positive, correct? Over here as well, if the portfolio is outperforming the market, my m squared is positive. So what is the formula? Guys, don't worry about the formula. The formula is not very typical, very logical. It is RP minus RF. What is RP minus RF? Can I say RP minus RF is nothing but the excess return on the portfolio? Excess return on portfolio, correct? The second term, RM minus RF, can I say this is excess return on market, correct? Excess return on market, okay. But can we simply subtract excess return on the portfolio with the expected excess return on the market? No. Why? Because the bases are not similar. What is these bases? The bases are the risk. So guys, we have to make the bases same. How do we make the bases same? We have to use the risk measure. Now, ideally, we could have both used beta as well as sigma. Okay. But since this is a measure based on total risk, we are using a sigma. What we are doing? We are using a simple unitary method. Again, we have discussed about this in detail during the capital market line concept. What are we doing? We are initially dividing it by the sigma of the portfolio, which means initially what we are doing the excess return based excess return per unit of the risk that I am taking. So this measure is the Sharpe ratio, correct? RP minus RF by sigma P is nothing but the Sharpe ratio. But again, what we are doing, since we have to compute the excess return, we are multiplying it with the risk of the market. What does it mean? It means that what is the excess return that I am getting per unit of my portfolio risk, and then I'm multiplying it with the market risk in order to get that if my portfolio had taken the market risk, what would be the excess return that I would have got minus what is the excess return from the market. So because we are using the measure sigma over here, we are saying it that it is an extension of the Sharpe ratio, but you will see similar thing we were doing with the uh, Jensen's alpha as well. We were trying to compute what is the excess return that I'm taking, excess return that I'm getting basis the beta risk or the beta with the systematic risk. Over here, we are doing what is the excess return that I'm generating basis my system, basis my sigma or the total risk. Guys, are we clear? So with this, guys, we are completed with the portfolio risk and return part 2. I hope you have found this entire series of part 1 and part 2 useful. Student usually, miss the linkage between the entire topic risk return, comparing all of them. So I've tried to help you, understand it in details. In the next video, we will do some other topic. Till then, stay tuned and happy study. Just one more thing, guys. I guess I missed this point. Suitability. Okay. What is suitability? Suitability is basically making decisions on the portfolio basis the performance evaluation. So what it is saying that a portfolio that lies above the CML will have a Sharpe ratio than those of any portfolio along the CML and have a positive M squared definitely. So basically it is saying that if there is a portfolio, if there is a CML like this, then any portfolio which is above the CML will have a M squared positive and will have a Sharpe ratio greater than this definitely. Further, a portfolio that lies above the SML, what is SML? Guys, remember CML is capital market line, SML is securities market line. CML was basis the total risk, SML was basis the systematic risk. So in CML, since we are talking about the Sharpe ratio and M squared, in SML we will be talking about Jensen's alpha and Treynor ratio. So for a portfolio that lies above the SML, they have a Treynor measure greater than those of any security or portfolio that lies along the SML and also have a positive value of Jensen's alpha. So this was total risk and this is systematic risk. Guys, are we clear? So I hope you found this video useful. In the next class, we will meet with another topic. Till then, happy studying.